Lecture 4 Trend versus Non-Trend Bars. In this lecture, you will learn different types of bars and how each type participates in patterns formation. Bars can be divided broadly into trend or non-trend bars. Non-trend bars, although they have different shapes, they collectively refer to as dojis. The main characteristic of dojis is that they have very short or non-existent body, so that open and close price of such bars are almost equal, reflecting the fact that neither bulls nor bears control the bar. Trend bars, on the other hand, are bars with a body that make up more than 50% of the whole bar length. The rest, of course, will be the upper and the lower tails. Trend bars indicate that there is a price movement, and the bar closed well above the open price, as in the case of a bull trend bar, or will below the open price, as in the case of a bear trend bar. Applying the previously mentioned definitions, there are three types of bars found in this chart. The first one is the bull trend bars, represented by these green bars, and the second one is the bear trend bars, which are represented by these red bars, and both are trend bars. Non-trend bars, or dojis as they are called, look like these bars, here and here and here. Technical analysts give specific names for these dojis depending on whether open and close price is clustered on the top, on the middle, or on the bottom of the bar. For me, those names are irrelevant and wasting valuable time and effort needed to evaluate the balance of power between bulls and bears. Most of the time, dojis mean nothing more than a pause in a price movement. In other times, as you will see later in this course, dojis in certain contexts give indication for reversals or trend continuations. But sometimes they are traps used by the market to keep counter trend traders in while keeping with trend traders out. In other words, during downtrend, the market uses dojis to keep bulls in and to keep bears out, while in the uptrend, the market tries to keep the bears in and the bulls out. In this example here, price made a new lower low here, trapping weak and latecomer bears. When the price retraced above the doji, those weak bears were forced to close their shorts with loss, which means they were buying back their shorts, feeding the pullback up and forcing more bears to exit their shorts. After a few legs up, the strong bears came back, selling aggressively and sending the price to a new low. Later, the market was stuck in range trading here. The market couldn't break out to the downside unless buyers who are bidding for a reversal are trapped and then forced to exit their long trades with loss, which what happened here. Along with the strong bears, the trapped buyers have sent the price to another lower low. But how traders are trapped by dojis? Because you might think now that dojis are reversal signals and you won't be trapped by them. To show you how you can trapped by dojis, let me remind you that most dojis were trend bars at some stage of their development before they shrink and close near the open price. Look at the development of this doji. At this stage, it looks like a strong trend bar, which motivates the emotions of over-eagerly buyers who didn't wait until this bar is finished. They bought heavily to catch the trend very early. Now look what happened later. The developing trend bar shrinks to a reversal doji, trapping all buyers. So whatever the time frame chart you are using, you should never ever use a developing bar as a signal and entry bar in the same time. Always wait for the signal bar to close, then look for the entry depending on the final shape of the signal bar. Unlike dojis, which are weak signals, trend bars are reliable signals, especially for range breakouts and trend reversals. But why trend bars are reliable? They are reliable because in a strong bull trend bar, for example, the buyers have already showed their strength and control over the bears, so it is safer now to jump to the bull's boat. In this chart, the market was in a tight range. And when the market is in a tight range, a strong breakout to either side of the range is expected. But to which side it is hard to know. The market will show several failed breakouts and traps traders before the real breakout comes. And usually the real breakout expresses itself in a strong trend bar, which should be the signal bar for the new trend. In this case, the signal bar here was a strong pull trend bar. However, to reduce the risk of a failed breakout, we must wait until the signal bar is closed and seek entry in the next bar or bars when the market goes above the signal bar. Here, for example, is a perfect entry bar for a long trade setup. This example is similar to the previous one, in which the market was in a tight range as you can see here and where a strong breakout is imminent. As you can see, the market broke the tight range to the downside with a strong bear trend bar here, which is our signal bar for the breakout. Our entry bar should be the next bar in which the price goes at least 1 pip below the signal bar. Breakouts from tight ranges will be discussed with more details in section 5, which is about trading breakouts. You might have asked yourself, why should I wait for an entry bar to go beyond the signal bar? Why shouldn't I enter the trade at the signal bar? That would put me early in the trend and increase my profit. As I have said earlier, it is better to enter your trade after the signal bar closed, when the entry bar goes at least 1 pip above the bullish signal or 1 pip below the bearish signal bar. And I recommend this because it will protect you from traps or fake breakouts. I will illustrate this for you more clearly through this example. As you can see in this 5-minute chart, the market was again in a tight range, and then a bear trend signal bar broke below the range. But the breakout was fake, and there was no follow through. Then the market reversed very quickly to the opposite direction, trapping all sellers who sold at the signal bar without waiting for a confirmation for a follow through. That's why I always recommend that you need to wait for an entry bar that goes beyond the signal bar before entering your trade. This entry bar didn't go below the signal bar, and if you placed your sell stop order just below the signal bar, it will not be triggered. With this, we come to the end of this lecture, and in the next lecture I will discuss inside and outside bars and how they can be used in identifying profitable trading setups.